Great pleasure to welcome Douglas Radcliffe and Tom Grantham.
Excellent. Thank you, Mark, and good afternoon, everybody. As indicated, I'm Douglas Radcliffe, and I'm the Group Investor Relations Director for Lloyds. I'm also joined today by Tom Grantham, who is the Senior Manager in my team. As many of you will know, Lloyds Banking Group has the largest retail investor base in the UK. And so we are very happy to be running one of these retail briefings with ShareSoc. We view these events as an important way of keeping in touch with our shareholders. So thank you for joining us. You'll see that we've given some slides on the screen. Effectively, within this call, what I'm going to do is provide some context on the performance of the group, including a run-through of some of the key messages following our third quarter results that were issued at the end of October, as well as other market issues you might have heard about, particularly motor finance. This should take about 20-25 minutes, so there'll be plenty of time for Q&A. Before I touch upon financial performance, I'd just like to provide some context on the group and our current strategy. I'll start with a couple of slides which outline the group's business model and key product areas. Some of you may well know this detail, but I thought it was helpful as a bit of background. Lloyds is a UK-focused retail and commercial financial services institution. We have a relatively simple operating model with business split across 3 reporting divisions: retail banking, commercial banking, and insurance, pensions, and investments. Within these divisions, we offer a comprehensive product suite to meet our customers' ever-evolving financial needs. The business scale is underpinned by a portfolio of familiar and trusted brands, such as Lloyds Bank, Halifax, and Scottish Widows, alongside a few newer brands you may be less familiar with, including Tusker, our car salary sacrifice proposition for corporates, and Lloyds Living, our private rental arm. As you can see, we've included a number of those brands on the slide itself. The breadth of our franchise provides us with unparalleled insights into the customers that bank with us, and allows us to develop more targeted offerings that deliver greater value for our customers and the group. It also creates a unique competitive advantage in the complementary products and services that we can offer. As ever, we are guided by our purpose of helping Britain prosper. I'll now go on to the next slide and particularly focus on our competitive strengths, which differentiate our proposition. As many of you will be aware, we are the largest UK bank with 900 billion of assets and 27 million customers. Not only do we have a broad and leading customer franchise, but we are also the #1 provider in several core products areas, including mortgages, cards, loans, and transport. Our capabilities across both banking and insurance offer a unique customer proposition within the UK, which is a clear competitive advantage. We have a clear strategic vision of being a UK customer-focused digital leader. One of our strengths is an all-channel distribution focus, leveraging our trusted brands. We now have 22 million digitally active users, and we're continually leveraging our digital capabilities to innovate and improve our customer products and services. Let me now hand over to Tom, who will provide an overview of our strategic focus areas.
Thanks, Douglas. In February 2022, our CEO, Charlie Nunn, set out a 5-year strategy for Lloyds Banking Group. We are focused on driving revenue growth and diversification, strengthening our cost and capital efficiency, and maximising the potential of people, technology, and data. In particular, our growth initiatives are focused on 4 key areas: deepening and innovating within the consumer space, creating a new mass affluent offering, building our corporate and institutional offering, and digitising and diversifying our small and medium businesses franchise. If you'd like any more detail on these initiatives, please do look at our website, as we have done a separate strategic seminar for each of these areas over the past year. Our strategic transformation is supported by £3 billion of strategic investment spend between 2022 and 2024, and a total of £4 billion between 2022 and 2026. We've now almost completed the third year of our 5-year strategy and are on track to deliver the interim 2024 targets, which I'll outline on the next slide. We are pleased to say that our strategy is progressing well, and this is translating into positive financial benefits. Our 24 targets include delivery of 0.7 billion of additional revenues from strategic initiatives in 2024, with this growing to 1.5 billion per annum by 2026. We are also on track to deliver 1.2 billion pounds of gross cost savings this year. Our performance to date gives us confidence in our 2026 targets. This includes a return on tangible equity of greater than 15% and capital generation of more than 200 basis points in 2026. Finally, Douglas will now touch on shareholder distributions on slide 7 before we move on to our latest financials.
Thanks, Tom. The group's strong capital generation continues to support growth in shareholder distributions. At the half year, the board announced an increased interim dividend of 1.06 pence per share. That's a 15% growth on last year. As usual, we will consider further capital distributions at the year end. Both the interim and final dividend per share have grown consistently over our strategic plan. The 2024 interim dividend per share announced at the half year is around 60% higher than in 2021. This strong distribution growth is consistent with our guidance for a progressive and sustainable dividend. Alongside this dividend growth, Lloyds have executed consecutive and significant share buybacks. The buyback last year was 2 billion. These buybacks have reduced the group share count by around 12% since the end of 2021, supporting growth in shareholder value. We remain committed to distributions and returning excess capital to shareholders. I will now talk to our latest financials. I'm going to largely reference the slides we used with institutional investors at the third quarter results, as I think it's helpful for you to see what was presented, but I will bring focus on specific areas that are worth highlighting. So let's start on the next slide, slide 8. Within our third quarter results, there were 3 key messages throughout our presentation, as outlined on this page. Firstly, we continue to make good progress on our strategy. Secondly, in the third quarter, the group again delivered a robust financial performance. This included income growth alongside cost discipline and strong asset quality. Finally, our performance, as well as the strength of the group's franchise, allowed us to reaffirm our 2024 guidance and give us increasing confidence in our 2026 commitments. I'll now turn to a summary of the financials on the next slide. As you can see, and as you may well have read when the results actually came out, statutory profit after tax for the first 9 months of the year was 3.8 billion, with a return on tangible equity of 14%. Pleasingly, the third quarter saw growth in income versus Q2, including net interest income up 2%. This was supported by a quarterly net interest margin of 2.95%, up 2 basis points on Q2. On a year-to-date basis, other income was up 9% on the prior year, driven by growth across our business. We remain focused on costs, which were up 5% year on year, in line with expectations. Asset quality remains strong. The year-to-date impairment charge of 273 million equates to an asset quality ratio of just 9 basis points. Tangible net asset value per share, which is effectively the tangible book value of the company per each share, increased to 52.5 pence, up 2.9 pence in the third quarter, driven by both profits and the unwind of the cash flow hedge reserve given falling rates. Our performance delivered strong capital generation of 132 basis points in the year to date. in line with our guidance of 175 basis points for the full year. I'll now turn to the balance sheet growth on the next slide. Our customer franchise continues to grow. Our total lending balances of 457 billion were up 4.6 billion in the third quarter. This was primarily driven by strong mortgage book growth, up 3.2 billion, reflecting a strengthening market throughout this year. We have written a market share of new business that is in excess of our share of stock, which is about 19%, supported by improvements to our customer proposition off the back of our strategic investments. Elsewhere in retail, we saw continued growth across cards of 0.1 billion and unsecured loans of 0.6 billion. Commercial lending balances were down by 0.2 billion in the third quarter. Within this, we saw similar trends to recent quarters, with growth in our corporate and institutional franchise more than offset by the impact of continued repayments of government-backed lending across small and medium businesses. Our deposit franchise also continues to perform strongly. Deposits of 476 billion were up 1 billion in the third quarter. We saw growth of 1.7 billion in retail. Our savings were up 2.8 billion. Current accounts were 1.1 billion lower in the quarter, but that performance was actually a little better than we expected. The churn we saw in deposits, a key metric that measures both the movement from current accounts into savings and within savings from instant access into fixed term deposits, continues to ease. This is as expected in a declining rate environment. Commercial deposits were down 0.5 billion quarter on quarter. Growth in targeted sectors within small and medium businesses was offset by an expected outflow in corporate and institutional. Alongside these deposit developments, insurance, pensions and investments saw 3.5 billion of net new money year to date. So turning to income on the next slide. As mentioned, the group delivered income growth across both net interest income and other operating income in the third quarter. Net interest income of 3.2 billion was up 2% quarter on quarter. This includes a net interest margin of 2.95%, also up slightly, up 2 basis points in the quarter. This was driven by a strong contribution from the structural hedge, which more than offsets the ongoing headwinds in mortgages and deposits. As background, the structural hedge is effectively a tool to manage interest rate risk. It does this by hedging our rate-insensitive balances, primarily current accounts, by investing in interest rate swaps over a longer period of time, generally 3.5 years. The structural hedge notional balance remained unchanged at 242 billion after reducing 5 billion in the first half of the year. This reflects increasing stability in our rate-insensitive deposit balances. Looking forward, we continue to expect the 2024 net interest margin to be greater than 290 basis points. Year-to-date average interest earning assets, or AIEAs, are 450 billion, with healthy growth in the third quarter led by mortgages. We continue to expect average interest earning assets to be greater than 450 billion for the year as a whole. Our other income, primarily fee income, saw continued momentum in the third quarter. Year-to-date OOI was 4.2 billion, up 9%, with Q3 up 3% quarter on quarter. Our performance this year continues to be driven by stronger activity and also reflects our strategic initiatives across the divisions. Operating lease depreciation was 315 million in the third quarter. This is consistent with our expectations as set out at the half year, based on business growth and revised depreciation schedules. So let me now move to costs, as you can see on the next slide. We remain on track to deliver our operating cost guidance of 9.4 billion in 2024. The third quarter operating costs were 2.3 billion, stable quarter on quarter. Over the first 9 months of the year, operating costs of 7 billion were up 5% year on year, or 4% excluding the sector-wide 0.1 billion Bank of England levy that we took for the first time in the first quarter of this year. This also includes accelerated severance charges versus 2023, taken to facilitate cost efficiencies. Excluding both the levy and the component of severance, which is in excess of last year, costs were up just 2%. Inflationary pressures are being significantly offset by continued cost discipline and investment in savings. The Q3 cost-to-income ratio is 53.4%, or 52.7% excluding remediation. The remediation charge is 29 million in the quarter and 124 million year to date. Stepping back on this point, I thought it was worth noting that since we published our Q3 results, we have seen the Motor Court of Appeals ruling. These rulings relate to commission disclosure and consent obligations for motor finance, which go beyond the scope of the previous FCA Motor Commissions review. We published a stock exchange announcement shortly after these court outcomes, noting that the group is assessing the potential impact of the court decisions, as well as any broader implications pending the outcome of the PL applications. We believe we met all regulatory rules in force at the time, but this case relates to the interpretation of the law. We will update the market if and as appropriate. We are very happy to take any questions you have on the topic in our Q&A session following this presentation. Although we'd note that at this stage, there are a number of uncertainties relating to the likely outcomes, and therefore we may not be able to give a significant amount of further detail. I'll now hand over to Tom, who will talk through the asset quality in a little bit more detail.
Thanks, Douglas. Asset quality remains strong and reflects resilient credit performance. The Q3 impairment charge is 172 million, equivalent to an asset quality ratio of 15 basis points. This benefited from strong portfolio performance, but also a debt sale of unsecured assets, providing a circa 80 million credit. Year to date, the impairment charge is 273 million. This reflects a low underlying charge, helped by some one-offs, and an improving economic outlook in the first half of the year. The impairment charge reflects both portfolio performance and economic developments. On an underlying basis, after removing benefits relating to the economic environment, the impairment charge is a still low 597 million, or an AQR of 18 basis points. Looking forward, we continue to expect the asset quality ratio to be less than 20 basis points for 2024. I'll now touch on return on tangible equity and our tangible net asset value. Return on tangible equity in Q3 was 15.2%, contributing to a robust year-to-date performance of 14%. Tangible net assets, or TNAV, per share at 52.5 pence are up 1.7 pence year-to-date and up 2.9 pence in Q3. The increase over both periods was driven by profits and the unwind of existing headwinds, offset by shareholder distributions. Looking ahead, we continue to expect TNAV per share to grow as headwinds further unwind and that reduced share count from the buyback continues to provide support. We also continue to expect the group's return on tangible equity to be circa 13% for 2024. This incorporates ongoing TNAV growth alongside slightly lower fourth quarter earnings, given the usual seasonal factors, such as the bank levy and a more normalised impairment charge. Turning now to capital generation on slide 16. The group delivered strong capital generation in the first 9 months of the year of 132 basis points. This keeps us on track for our target of circa 175 basis points for the full year. Within this, risk-weighted assets are 223 billion, up 4.2 billion in the first 9 months of the year. This continues to be largely driven by lending growth, partially offset by securitisations and other capital optimization activity. We remain confident that RWAs will end the year consistent with guidance of between 220 and 225 billion. Our closing CET1 ratio for the quarter is 14.3%, well ahead of our target to pay down to 13.5% by the end of this year and to pay down to 13.0% by the end of 2026. I will now move on to slide 17 to wrap up the presentation. Overall, the group delivered a robust financial performance in Q3, with income growth, disciplined cost management, and strong asset quality, together driving strong capital generation. This performance allowed us to reaffirm all of our 2024 guidance, and we remain confident in our 2026 guidance as well. This is set out in full on the slide. That concludes our comments. Thank you for listening, and we now have some time for Q&A, which we can open up to the audience.
Excellent. Thank you very much, everybody. So I think a number of individuals have been submitting their questions online, and indeed we had another question in advance. So what I'll do is I'll just make my way through the various questions, and I hope to answer those questions in detail so that you have the appropriate responses. So unsurprisingly, there have been a couple of questions relating to both motor finance and indeed the share price. So it probably makes sense to cover off both of those two together, because I think there is very much a correlation between the two. So let's look at the motor finance side. Clearly, as I referenced earlier, the Court of Appeal ruling on motor finance was a surprise to all. In essence, it changed not just our understanding of the law, but the market's understanding of the law. So hence why there are an awful lot of people at the moment that are essentially reviewing and working out the implications of these changes. In essence, however, there are a huge amount of uncertainties with regard to motor finance and how it plays out. Firstly, when you look at it, a lot of those uncertainties relate to the judicial approach and how it progresses. As I mentioned earlier, essentially, these weren't our cases, but they were cases brought by other providers. Close Brothers, who effectively lost out on that case, have now actually appealed to the Supreme Court. Basically, we are yet to hear as to whether the Supreme Court will accept the appeal. If they do accept the appeal, there will then be a question about how long it will be until the Supreme Court can actually be held. And then there'll be a question as to what actually the Supreme Court rules. Because in essence, the Supreme Court is the one court, obviously the most senior court, that can effectively overrule the Court of Appeal. They may or they may not. They may well agree with the Court of Appeal. So we just simply don't know. That's an uncertainty, both from a timing perspective and indeed what comes out. But it's a huge uncertainty as to how people look at this. Secondly, if you actually also from a judicial perspective, in the fact that the way that the Court of Appeal ruled was that they, in essence, agreed that any remedies that would be made to customers for historic motor finance sales, those remedies would be agreed by the lower courts. So as yet, we haven't had those lower court cases, and it's yet to be seen as to exactly what the timing of those court cases would be. But certainly from the perspective, it actually makes a difference from a time perspective. So you've got a couple of things that relate to the actual judicial system and the time it takes to actually flow through. Secondly, there's an element of actually looking at the application of the ruling and clarification of what the ruling means. Does this just relate to vulnerable customers? Does it relate to sophisticated customers? How do you define vulnerable customers? What does the documentation actually state? Which sales process does it relate to? And as I said right at the start, I mean, in essence, this Court of Appeal is relating to disclosure and consent of disclosure rather than the previous almost like FOS case that was very much about fairness of commission. So when you think about it from that perspective, there's then a question of, well, what products does it relate to? And that's been a question that the clarification has been looking towards. Generally, the view is that motor finance is the main area that the focus is on, but there is still additional clarity that's needed. And the final area is, I suppose, of uncertainty is what the regulators do. In essence, from a regulatory perspective, the FCA have already come out with announcements. They've already talked about the fact that actually they would advocate this going to the Supreme Court, and they've indicated that if it does, then they would essentially provide additional detail, or would like to submit additional detail, because essentially from a regulatory perspective as well, they're looking for clarity. So a huge amount of uncertainty. A lot of that uncertainty is actually external, whether it comes from the judicial uncertainty, whether it comes from the facts, or whether it comes from the FCA. So because you've got that uncertainty out there, it's really uncertain what the impact is for us as a business at this moment in time. So clearly that's why we haven't come out with any formal number or anything like that. That analysis is being undertaken, but a lot of that uncertainty relates to the external environment. What we have tried to do is be as clear as possible and transparent on detail. After the Court of Appeal, we put out a stock exchange announcement on the first Monday. The Court of Appeal came out on the Friday. We went out on the Monday. And then subsequently, we've done various conferences and seminars where management have presented and have updated and clarified the position and how it stands. Very much in line with what I'm telling you today, but I think it's helpful. If you were to go to our website, you can see our Chief Financial Officer presenting at the UBS conference. You can see him presenting at the JP Morgan conference. Very much more about talking about the uncertainties that are out there. So I suppose the biggest element of all of this is what does this mean for the group, and what does it mean for capital return? In essence, as an organisation, we've been very clear about the capital position, the capital generation of the group as a whole. In essence, we generate, we've got very strong capital generation. We generate about 175 basis points of capital a year. Actually, if you look at our strategy, it actually increases to more than 200 basis points by 2026. If you look at our capital position remains strong. Our capital position was 14.3% at Q3, so you can see that demonstrated through there. You can also see, we've made it very clear that we're committed to capital distributions, and indeed that we are looking to pay down to 13.5%, at the end of this year, and 13% by 2026. And actually, all of that remains the case. If you look at our commitment to capital distributions in previous years, as I referenced in the slides itself, I think last year we distributed about 3.8 billion. So look, the approach, the commitments, the objectives, the capital generation of the business fundamentally haven't changed. We are where we are at that moment. But what we now have is the uncertainty that comes through this Court of Appeal ruling, which clearly we'll have to take into account. It implies, as I talked about earlier, a number of uncertainties, many of which will actually take time to play out. As I said, that if it does go to the Supreme Court and they accept it, it's highly likely that won't play out for at least another 4 to 6 months, and could actually be longer. So what we're going to have to do as an organization is basically consider the status of play at any one point in time, look at the alternative scenarios around those issues at the time of the year end when capital decisions are generally made, alongside our commitment to capital targets and capital distribution. So it provides an element of uncertainty, but we remain committed. I say the capital strength of the business remains strong, the capital generation remains strong, and we remain committed to distributions. So Look, it's a predicament that the board are going to have to look at. They're going to have to look at it, in advance of the full year results, which are at the end of February. So I think, that's where we are at the moment. But, I can absolutely assure you that, there certainly is a commitment from the board, and they understand their obligations to shareholders when it comes to capital return. Probably as a related to that, it probably makes sense to touch upon share price performance and relative share price performance, because naturally, I think since the Court of Appeal ruling has come out, the share price for Lloyds Banking Group has clearly been impacted relative to our peers, largely because we have such a strong position in motor finance, where we've got about 14-15% market share. But Tom, why don't you talk about some of the relative share price performance?
Yeah, thanks, Douglas. And as said, clearly there has been an impact on our share price from motor finance. So probably the best way to see that is actually UK banks, particularly domestic UK banks, have performed well this year. So up substantially more than sort of double-digit percentage terms. We are up 11% year to date on a share price perspective. And obviously that doesn't include the buyback that has been ongoing through the year, and the interim dividend we paid at the half year. It was up 15% year on year. So we have still been positive from a total shareholder return perspective, but equally we understand that we have underperformed some UK domestic peers. As Douglas said, the reason for that is clearly linked to motor finance. If we look at when our share price has underperformed specifically, it was in January when the Financial Ombudsman decision came out relating to discretionary commission arrangements, and it's post-October since this Court of Appeals judgment has come out. And we understand ultimately that there is uncertainty, exactly as Douglas just described, and investors don't like uncertainty. And we therefore understand as well that people have their own estimates for what this could mean in terms of a total provision, or if there is a provision, and what that might ultimately mean for the company. And so we understand therefore why the market might be discounting our shares on that basis, and therefore leading us to a relatively worse performance versus our peers. So we understand all those concerns. I think Douglas set out sort of what were our current thoughts on it, but we do feel like that is the primary driver for why we're underperforming peers at this point in time.
Excellent. Thanks, Tom. There was also another question actually related to dividends versus buyback, and specifically looking at whether a buyback is actually relevant or not. So let's just cover first of all what our dividend and capital return policy is. Essentially, this has been the case for a number of years now. What we've got is effectively a progressive and sustainable ordinary dividend. So what that's basically indicating is that we would generally expect the ordinary dividend to increase year on year. Clearly, there may well be a time where that doesn't continue, but at this moment in time, it's very much progressive. It's very much sustainable. If you look at, both I mentioned it in the presentation, Tom just mentioned it just there, the actual ordinary dividend increased by 15% at the half year. If you actually go back to the full year of last year, it increased by 20%. If you look at it on the year before, it had increased by 20% as well. So we very much have a progressive and sustainable ordinary dividend. Actually, if you look at last year, that probably equated to about 1.8 billion overall capital return. Then on top of that, what we've said is that we've got a commitment to returning excess capital. So last year, that was 2 billion. So we actually undertook a 2 billion buyback during the course of the year. And essentially, that's just a buyback in the market. So it's just done directly on the stock exchange, and we would just buy a proportion of the shares that are being sold by any one person in the market on a day-to-day basis. So that's actually now completed for this year. So we did that 2 billion. We completed it, must have been about 2 weeks ago now, 3 weeks ago now. So when you look at it, in essence, the way that the buyback works is, if everything was equal in the markets, if you reduce the number of shares in issue, the value of each share should be worth more, assuming that actually the value of the organization is the same. So actually buying back shares, in theory, is to the benefit of existing shareholders that retain holdings. The challenge has been, however, that obviously there have been a number of other external factors that have actually impacted the share price in the meantime. Now, what that has meant is obviously if the share price is lower, then you're actually able to buy back those shares at a lower price, which is good because you can buy back more shares. However, what it's showing is that there are external factors in the market that offset the benefits of that buyback. And that's why when you look at the actual share price performance, the share price performance is being driven, as Tom says, by the external factors, not by the fact that buyback is in place. And it's just a case of they happen to be in there at the same time. There's always a number of different dynamics, a number of different forces in play when it comes to the share price. But that's almost like the correlation between the buyback and the share price itself. So that, I think, gives a flavour of the buyback and how we look at it versus the ordinary dividend. Next question is looking at the mass affluent market and our ambition in that area. What's your definition of mass affluent and what products and services do you see as being key to this market? Tom, do you want to start off just by giving a little bit of detail in that area?
Yeah, no problem at all. So in terms of how we define mass affluent, so it relates to a higher value customer segment where income or wealth is above 75,000. Now, we came out with that disclosure back in March this year when we did our seminar on mass affluent. And I think it's worth for anyone more interested in the details around that to look at that seminar, which is on our investor relations website. Obviously, that 75,000 could change over time, depending on inflation. But ultimately, the reason we're targeting that segment is we feel there is an addressable gap there. High net worth individuals often are able to afford more comprehensive financial advice. But we feel below that segment, you've got mass affluent, where they don't necessarily want to spend a huge amount of financial advice, but equally have the savings and the wealth that can make it worth their while if they do invest and look at alternative ways that they can use their money. And so we feel we can come up with tailored products for those types of clients and also come up with relatively low cost financial advice to help them. In terms of how we've done that, so we've come out with a few products. We've got ready-made investments, which is essentially an investment arm or investment product that customers can sign up to. We also have Lloyds Bank 360. Those are both mass affluent specific products. And I guess why we think we have a right to win in this area is ultimately we are the biggest UK consumer bank. So we have 27 million customers, as Douglas said, and therefore a high proportion of those are digitally active. And therefore we feel we can address that need and address that gap with those tailored products. And we're seeing really good take up so far. We're getting particularly good traction with younger customers, so particularly the under 30s. And that ultimately is feeding into our ambitions of generating more revenue. They're generating more AUMs that ultimately will create sustainable revenues over the medium term. I think in the question you referenced competitors and others doing it. There are obviously others that will be operating in the same space. As said, we feel we have the right to win given our size, given our unique relationship with those customers and the fact that people already use our app as almost a one-stop shop for their financial needs. And therefore we feel we're best placed to serve those customer needs.
Excellent. Thank you, Tom. Another question that's come in is essentially asking about our expectations for the trajectory for interest rates and how this will affect the group's performance. I think that's a really interesting question because in essence, look, Lloyds Banking Group is very much a UK focused company. 97% of our assets are in the UK, and often we are very much used as a proxy for the UK economy. So I think it's not just interest rates, it's actually looking at other economic forecasts. In essence, what we're expecting is that there will be another 3 base rate cuts in 2025. And when you look at it from a bank rate perspective, then there to be further cuts down to probably about 3.5, 3.6%, something like in 2026. So we are expecting interest rates to fall over the next couple of years. If you look at it from an inflation perspective, inflation we're probably predicting is about 2.6% this year, probably a similar amount next year, and then coming down to slightly over 2% in 2026. If you look at it from a house price perspective, we're projecting house prices in the UK to increase slightly this year to probably about 3%, and then slight increases in the next couple of years, but certainly coming down slightly, probably almost like flattish by 2026. And we're expecting unemployment to remain pretty stable around the 4.7, 4.8%. So actually a pretty benign, a pretty stable economic environment in the UK. if you look at the impact of that on the earnings and the profitability of the group, it's quite interesting, and you may well have seen it in the third quarter results. What was really important and indeed interesting from the third quarter results was both our net interest income and our net interest margin increased, despite the fact that base rates fell. And we very much believe that actually, even in a lower rate environment, our net interest margin and our net interest income can increase. And basically that's because of 3, maybe 4 key factors. Firstly, you've got the fact that actually, we're investing in our strategy. It was talked about earlier in our presentation, and that strategy delivers over time. We've talked about having an additional 1.5 billion of revenues coming from the strategy by 2026, of which 700 million by the end of 2024. So that clearly helps from a revenue perspective, the strategic investment that's being made. But at the same time, you've got benefits of reinvesting your structural hedge at higher rates in the market. You've got mortgage repricing. Although the mortgage market is actually very competitive at the moment, the actual and the margins on new business are less than they were 2-3 years ago. Essentially, that back book of the higher margin business rolls off, and it's rolling off at the moment, causing the bank pressure from a margin perspective. But that eases over the next couple of years, and indeed should have played through largely by the middle of 2026. In the same way, from a deposit side, as rates go up, you tend to see a bit more deposit pressure with people moving balances from current accounts to savings to fixed term deposits. But what you tend to find is that starts to ease as rates reduce. And that's exactly what we're seeing at the moment. So I think our view is that generally, actually, although you would expect rates to fall next year, we would expect actually, net interest margin to increase and net interest income to increase. At the same time, you're seeing growth in other income of 9%, as I talked about earlier. You've got costs that are growing slightly. Effectively, we talked about 4-5%, year on year. But some of that is because of you've got the Bank of England levy that's come on board this year. You've got additional severance costs. So the underlying increase is probably more like about 3%. So you've got various different factors in play that impact it going forward. And I think that's, those are the key drivers when you look at the top level. Looking at the next questions coming through. How would you describe your relationship with government, and what do you expect the effect of developing government policies to be on your business? I think relationships with regulators and government have actually improved, a fair amount over the last couple of years. And I think there's a general acceptance, I think, from a government's perspective that actually growth is important for the UK economy. I think there's a general acceptance that stability is important for the UK economy. And I think there's a general acceptance that banks have an important role in enabling growth in the UK economy. So actually, I think that that's been good from that perspective. At the same time, I think actually the recent Mansion House speech from the government was actually relatively positive when it actually came to looking at different elements, whether that be the focus on growth or indeed other mandates. I'm not sure, Tom, whether there's anything else that you'd want to add to that, but I think generally the market is sort of favourable at the moment, obviously with the exclusion of this regulatory issue when it comes to motor finance.
Yeah, I think that's a very good way of characterising it. I think when we think about not just the new government, but all governments, I think Lloyds has a unique position in the market in terms of the scale of our balance sheet and also just how much we interact with customers and consumers across the UK. So in terms of how that impacts, I mean, obviously, we are particularly keen on things around housing, around infrastructure, also sustainable infrastructure, and also financial planning. And those are specific areas where we feel given our expertise and given our size, that we can add a lot of value to both the UK, but also when we think about partnering with the government. And so we're definitely keen to support the government in their ambitions around that.
Excellent. Thank you. There's another question here on whether Lloyds pays commission to mortgage and insurance brokers and whether there's an issue, relating to the motor finance situation and product creep. It's a very interesting question. It's a very fair question, and certainly it's one of the reasons why I think people are generally looking for greater clarity from the Supreme Court as to how far it extends. As I said, when you look at the Court of Appeal decision, the Court of Appeal decision was very much on commission disclosure and consent. It wasn't really about motor finance. So, there have been a number of questions. Now, it does remain uncertain, but, our current view and expectation is that, we think that actually when it comes to looking at mortgages, when you look at insurance and insurance brokers, almost like the approach that's in place, the commission disclosure arrangements that are in place, the different areas that and policies and agreements that have been agreed seem less likely to be impacted by the findings of the Court of Appeal case. We can't guarantee that at the moment, but that's very much the expectation as a business. You'll see that we actually made some changes to the way commission was disclosed in motor finance, but actually that's the only business area where we felt the need to do that. So we can't discount it. We want the clarity, but at the moment we feel as if that's less likely to be the case. So a couple of other questions coming through. There's a question on increasing average number of products sold by customers when the strategy was launched. In essence, you're absolutely right. And this was part of the retail distribution strategy and the retail focus. And in essence, we were looking at enhancing the number of products that are sold to customers. We'll be providing an update on that with our February results. Basically, as we said earlier, our strategy right at the start was a 3-year and a 5-year strategy. So we come up to the end of that first 3-year period at the end of 2024, and we'll be updating the market. Progress continues to be made, but we'll be providing more detail at that time. There's a question here on retail and delinquencies, defaults, retail impact. Tom, do you want to cover a little bit of that?
Yeah, no problem. So the question is about our retail customers, how resilient are they? Are they feeling under pressure from cost of living concerns, etc.? I think the first thing to say is the UK consumer has been highly resilient. And that's both a general comment, but then also specifically for our lending, we have seen a very resilient consumer. You can see that across a number of different metrics. So new to arrears within mortgages, for example, is falling from already low levels, and that's levels that are below pre-pandemic new to arrears. And you're seeing that, frankly, across a number of different products. So credit cards, personal loans, they are all below new to arrear levels that we saw pre-pandemic. Likewise, and I know your question was about retail customers, but going outside of that, in the commercial space, again, very low new to arrear levels, low early warning indicators, and frankly, credit indicators that are below where they were pre-pandemic. I guess the wider question, how has the economic environment impacted retail customers over the last year? I think we've seen that retail customers have made sensible choices about the way they spend. They've maybe substituted, they maybe making alternative choices if they, for example, have to refinance into a higher mortgage. But as said, we haven't seen that translate into delinquencies or defaults. And one of the reasons for that is our prime customer base, the fact that ultimately our customers are highly resilient to changes in the economic conditions. But the second reason for that is that ultimately, we've also seen things like wage inflation pick up over the last year or so, and that has supported. And the way you can see that is, like as said, our asset quality ratio is very low and continues to be low, and we expect that to remain benign over the next few periods. You can also see, for example, that in deposits have grown despite the fact there are clearly those cost of living pressures. Actually, the deposit market has grown during that time in the retail space. And so I guess we'll have to wait and see what happens with the economy. And we set out, as Douglas did earlier, our expectations over the next couple of years, but we continue to see strength across retail customers. And in terms of your question about where that then translates into lending demand, as said in the presentation, mortgages have seen very healthy growth. And so we've seen customers respond to the lower rates there. Also, the fact that house prices are starting to increase. And that's what's driven the growth in the mortgage book. So 3.2 billion in Q3, which is about 1%. That's what's driven that growth. And that's what we think will continue to drive further mortgage growth over the next year or so.
Great. Thank you, Tom. Another question, I suppose a relatively simple one, relating to at what level interest rates will settle at. We believe that actually interest rates will settle probably about 3.5%, something along that sort of level. And what's really evident from that perspective is that this is a much better operating environment for banks. Clearly, if you go back 3-4 years when rates were very low, when rates are out, just slightly over 0%, that's not a very good or not a very favorable environment for banks, because you don't have the ability to manage both the asset and liability side of the balance sheet to the same extent. So actually, if rates are at that 3.5% level, then that's relatively comfortable from that side. Other questions here. We've got a question on AI and how it's gone. Thomas, do you want to add anything in from just an AI side?
Yeah, definitely. And I think Charlie Nunn, our CEO, has made a lot of comments on AI, because I think he definitely sees the impact that AI can have and also use cases within the bank. I think in terms of what we're saying publicly at this point, we're being cautious about the way that we integrate it. As said in the question, we've hired a high-profile head of AI from Amazon, which is encouraging, and I think does show the direction of travel for Lloyds, that ultimately we're offering a compelling opportunity for people that previously would have worked in big tech. I think that's encouraging. Likewise, we're hiring a number of data engineers. And again, we're sort of shifting our employee mix to, I guess, the skills of the future, which are ultimately going to help Lloyds continue to progress over the next few years and align with our strategy and some of our digital initiatives. In terms of use cases, I won't go into too much specific examples. What I will say is that in terms of customer impact, we'll be very cautious, and it's not something that's going to happen in a short period of time. We understand the issues that doing AI on a customer level and a front office level can have, and therefore there'll be a lot of test and learn. There'll be a lot of making sure that something is right and is a good fit for customers. And like I said, there's no imminent plans to bring those in any sort of major way because of the concerns that we have, but obviously it's something we're investigating. From a back office perspective, there's clearly opportunities from integrating AI into things like complaints handling, or for when colleagues look up customer details, for example. There's clearly benefits that AI can bring to make that more efficient and more quick. As a team, we're always looking at AI as well and how it can improve our own processes. And that's probably more from a cost perspective, but clearly there's revenue benefits there potentially as well. But as said, I'm sure we'll talk about that more when we talk about our strategy update in Feb 25.
Excellent, thank you. Another question, which was a follow-up, was just a little bit on my responses earlier about the buyback, and asking really whether we cancelled the shares after we had bought them back. And yes, indeed we do. So in essence, we'll buy back shares on the market themselves, on the market itself, just on any day's trading, and then we will cancel them. So that's from there. There was a question here on charges for community accounts. I'm not going to go into the detail on specific pricing on individual products, but what I would say is that clearly when we look at charging for for any customer segment, we're very much looking at it on both from a customer and a customer service perspective, and also a value and a profit perspective. And it's very much the way that we run the organization as a whole. Our whole mantra, our whole purpose is about helping Britain prosper. So, where we can, it's about enabling customers, to do the right thing and to grow. And that's how we look at it. But it's also a case of making sure that we're actually looking at it on a value basis at the same time as a pure service basis. So I'm not going to go into individual pricing here of products, but, those sort of pricing decisions are always reviewed on an ongoing basis. I think there was another question that actually, a similar question actually on Halifax share dealing and client accounts. But again, I think it's the same in the fact that, this probably isn't, the right place to answer, questions like that. Cost to earnings ratio, 55%. Clearly, the questioner here is looking at how do we bring it down further. And actually, if you look at our guidance is for the cost income ratio to be less than 50% by the end of 2026. So from that perspective, we very much expect that to improve over the next couple of years. That will improve for a couple of reasons, naturally, because it's the cost to income ratio. One, you'll have controlled costs. As I've talked about already, actually, if you look at the underlying cost inflation, cost growth at the moment, it's probably about 2 to 3%. And actually, when you look at the inflation rate in the economy, that's a pretty good control of costs. And actually, the group has a very strong reputation for managing the cost base effectively. So that will continue. That will continue over time. And what you'll do is you'll get the benefits of strategic investment, flowing through into the cost base as well. At the same time, as I've already talked about, you're going to have benefits from the income side. I've already talked about the fact that we believe that we can grow our income in an environment where rates are falling, and we can sort of grow both the net interest margin and the net interest income itself. So from our side, we've got levers on both the income side and the cost side to reduce that cost income ratio. So if you look at some of the specific initiatives on the cost side, I mean, there are plenty of initiatives. If you look at back office processing, if you look at efficiencies across the business, any bank that has been operating for a number of years, I think it's fair to say that they are not as efficient as they could be. And there are certainly significant opportunities when it comes through from a technology side. That's from there. We're nearly running out of time, but I think we've probably got time for the last question, which is actually relating to ring fence. And I'm not sure, Tom, whether you've got anything to add to this as well. I think when you look at ring fencing legislation, it was brought in post-financial crisis. It was brought in very much to protect consumers and split out what were effectively core retail franchises from investment banks, which is why you get a ring fence bank and a non-ring fence bank. So in essence, from that side, for us, it's probably less of an issue because the vast majority of our bank is in the core ring fence bank. So they're probably and you can see from a regulatory perspective that they are looking to change the actual legislation and look at opportunities for efficiencies and the way that the ring fence operates, and we welcome that as a bank that's actually largely ring fenced anyway. But Tom, I don't know whether there's anything else you would add to that.
No, I think you covered the main points. I think exactly that. It's less of a burden on us because most of our services are within our ring fence bank. And obviously those are our core services. And then some of the more risky activities is in the non-ring fence bank, although obviously some of our markets business is in the non-ring fence bank, which has been performing well recently. In terms of how much of an issue it is, it's not a huge issue in the sense that we can fund both with the relative funding that each group has. And so therefore it's just something that we have to deal with. And as Douglas said, there is legislation looking at whether there are things that can be done to make that more efficient. One of the things the government are doing is increasing the threshold to 35 billion, where you fall into the ring fence. That obviously won't impact us because our deposits are much higher than 35 billion, but maybe as an indicator of the direction of travel.
Excellent. Thank you. So that actually concludes the time. We pretty much, I apologize. I think we've gone 1 minute over. But thank you very much indeed for listening. I'm glad that my voice did actually last out the whole of the call. Thank you very much for your interest in Lloyds, and thank you for dialing into the call.